Hello dear friends, today is Wednesday, December 18. Let's look at the charts for the euro and the pound sterling and try to make some predictions. As we can see, the European currency remained range-bound, although it came under pressure from weak German business climate and current conditions data. Later in the day, the euro saw a slight bullish correction supported by data on US retail sales, which rose by 0.7% in November compared to the expected 0.6%. The British pound was quite volatile yesterday. Traders received important labour market data. The UK unemployment rate remained unchanged at 4.3%, while the number of people claiming unemployment-related benefits in November was well below market expectations, contributing to the pound's rally. As for where the British currency goes today, much will depend on statistics. Wednesday's macroeconomic calendar includes UK inflation data, with the consumer price index expected to rise by 0.1% in November, following a 0.6% increase in October. On an annual basis, UK inflation is forecast to reach 2.6% in the 12 months to November 2024, up from 2.3% in October. This could heighten concerns among Bank of England officials about rising inflationary pressures and potentially influence their future interest rate decisions. Consequently, tomorrow's BOE meeting is of particular interest to market participants. The euro area is set to release a similar report. Annual inflation in the region is expected to come in at 2.3%, with core consumer prices projected to rise by 2.7%, indicating stable inflation since September. If the results align with expectations, they are unlikely to have a serious impact on market sentiment. After all, ECB policymakers indicated last week that they plan to further ease monetary policy to support economic growth amid a slowdown in manufacturing activity and other challenges. All eyes today will be on the Federal Reserve meeting. The regulator is widely expected to cut interest rates by a further 25 basis points to 4.5% from 4.75%. The key focus will be on comments from Fed Chairman Jerome Powell regarding future monetary policy. Given the recent data showing rising inflation and a resilient labor market, it is likely that the US Central Bank will proceed cautiously with further rate cuts next year. Additionally, with Donald Trump set to take office in January, there are concerns that his policies could fuel inflation. Thus, a more restrained approach from the Fed could strengthen the dollar, exerting pressure on the euro and the British pound. Now let's move on to technical analysis. Given that the euro-dollar pair continues to trade sideways, it is quite difficult to predict where it will go next. According to the 1-hour chart, a false breakout at 1.0506, the middle line of the sideways range, will generate a sell signal, dragging the euro down to 0.482. A breakout below this level will open the way to 1.0458, while a more cautious approach to rate cuts from the Fed will take the euro to 0.430 and even 0.394. If the price forms a false breakout at 0.482 or 0.458, the volume of long positions will increase. If the price breaks through and consolidates above 1.0506, the European currency will rise to 0.534 and probably 0.567. At this level, I recommend going short on the rebound to catch an intraday correction of 25-30 pips. Short positions at 0.534 can be considered on a false breakout. In case the Fed takes an ultra-loose monetary policy stance, which is unlikely, the euro will have a chance to climb to 0.593 and even 0.627. As for the British pound, it has seen a strong bullish correction. Now bears are expected to regain control of the market. Data indicating easing inflation could weigh on the pound-dollar pair, with the price breaking below 26.95 or forming a false breakout at 27.25. In this case, sterling will dip to 26.67. After the third meeting, the pound could fall as low as 26.39 and 26.12. Traders are advised to go long on a rebound at these levels, expecting a move of 25-30 pips. Long positions at 26.67 and 26.95 can only be considered on a false breakout. Alternatively, if the price breaks through and consolidates above 27.25, driven by data signaling rising inflationary pressures in the UK, the British pound is likely to advance to 27.61 and probably 27.85. At this level, it would be wise to go short on the rebound in anticipation of a 25-30p move. Going short at 27.61 and 27.25 will only be relevant in the event of a false breakout. Best of luck.